Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as copper, gold, oil and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only. It doesn't take your personal situation into account. With all that said, let's jump in to our first chart. So we've got the SP 500 up here on the screen. And last week, we were talking about the first 2% down day since December 2022. Now, this week, the S&P 500 has had nearly a 3% downside reversal on Thursday. Recession fears, well, they're re-emerging, and that's been a big factor behind this week's volatility. So I think the big question here is, has the S&P 500 made a lasting high, and is it time to start reducing exposure? I've got a few charts to go through to help answer that. So let's start with this one here of the S&P 500. And if we step back and look at this chart structure, we have an index that's been broadly trending higher since October 2022. There have been several notable pullbacks along the way, and there's also been a brief false breakdown in October 2023. But overall, this upward trend has remained intact. And at this point, when we look at the current price action, at this point, all we have is a pullback to the 50-day moving average. This in itself is not a bearish signal. There's certainly scope for a larger consolidation. There's nothing to say this can't pull back further to the 100-day or spend time tracking sideways. But at this point, we don't have a bearish signal. And I think the underlying trend here, the underlying structure, it remains bullish. So a big driver of this pullback that we're having in the S&P 500 has, of course, been around big tech. So NVIDIA, for one, NVIDIA has pulled back to its 100-day moving average. Same sort of price action in Microsoft, pulled back to the 100-day moving average and now a little bit below there. We've seen the same sort of price action in some of those other big tech stocks. And as we discussed several weeks ago, both stocks were stretched above their moving averages, particularly NVIDIA. It really got stretched above both the 50 and the 100-day averages. And if a stock stays listed, at some point it is going to come back to these moving averages. It's inevitable that will happen. And in this situation, with these being two of the largest S&P 500 stocks, that's brought considerable volatility into the index. That's what's really driving this move back to the 50-day moving average. Now, this type of price action, it could develop into something bearish, but that hasn't happened yet. I think our default position should be to favor the incumbent upward trend, which remains up until we have clear evidence to the contrary. And at the moment, we don't have that evidence to the contrary. We've just got to pull back to a 50-day moving average. So that's what's going on with big tech. That's the big driver of the S&P. So what's going on in the broader market when we look beyond the big tech names? This is interesting, this indicator here. It's the percentage of S&P 500 stocks above their 100-day moving average. What's interesting when we look at this is that there's currently more stocks above their 100-day moving average than below. It's currently around 63% of stocks above their 100-day moving average. And despite the pullback that we've had in the S&P 500, the internal structure of the market is actually better than it's been in recent months. So you go back to this time last month, less than half the stocks were above their 100-day moving average. So there's more stocks above now than there was a month back. Another important part of this puzzle is to jump over to the equal weight, see what's going on with this. So this is an equal weight ETF, breaks the market into equal components, equal 500 components rather than that market cap based indice, which is largely driven by those big stocks. And what we have when we look at this, all-time high, hit an all-time high on Wednesday, pull back on Thursday. Thursday's fall whilst a notable fall, it only brings it back to where it was a few days ago, earlier in this week. So big down days, they make the headlines, but I think we need to keep them in perspective. We've got to look at how do they fit in the overall scheme of the price action. In this situation, it doesn't make a big difference at this point. I think in this case, the odds favour that it's part of an ongoing consolidation following the recent breakout. So a breakout from this large 3-month trading range that came in July. Equal weight's been consolidating since that point. So at this point, I think we look at this as part of that ongoing consolidation. And I think key levels to watch here are the 25th of July low, and also the 50-day moving average. If the equal weight was to make its way back down below these points, well, then this breakout would be shaping up as a false breakout, and that would be cause to go back and reassess the situation. But at the moment, rising moving averages prices are above moving averages. That's not bearish. Now, I've got one more chart to show you, but first of all, if you're getting value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. Just tells YouTube you're watching. YouTube shows other people. Helps me heaps. Please do that. Like, comment. Also, click that subscribe button if you haven't already done so. Now, another important chart, last chart for today, the small caps, the Russell 2000. So big down day in small caps on Thursday, but again, keep it in perspective. There was a large breakout in the Russell only a few weeks ago on around the 11th of July. Had a breakup from a multi-month, like what's that, around a 7-month trading range, breakout, initial rally, and then we're getting the consolidation following that rally. Last week, I said that healthy price action could entail several weeks of consolidation while the moving averages catch up. And I also noted that if you'd missed the initial breakout, then maybe the play was to just let the consolidation play itself out before maybe looking for an entry point. And I think that's most likely what's happening now. The consolidation is playing out. The moving averages are catching up. The price is moving sideways. As things stand, the bull market in stocks from October 2022, I think we've got to say it still remains intact. Of course, that could change, and at some point it will. But at the moment, it hasn't. And when it does change, that's what risk management strategies are all about. That's why we have strategies like trailing stops. Stay in for as long as possible. When we get that trend change, the stops get us out. I remain long stocks. I'm using those wide trailing stops, trying to see off the pullback that we're getting in stocks generally, and that's the way I think to play this market. Stay long, use that risk management. So, look, I think we will call that a wrap for this week. Thank you for joining me. Hopefully it's been interesting. Hopefully it gives you a few ideas. I look forward to coming back, talking to you again next week. Till then, bye for now.